nation's savings and investments. As long ago as 1974, told viewers of this program how important it was to get the capital gains tax down. And lately he has focused on repairing the damage Congress did in restricting IRAs. Yes, sir, a real 71-year-old new generation radical. Then there was another Clinton choice whose thinking is familiar to our viewers, Robert Reich, the next Labor Secretary, who reportedly was denied the job of Chief Economic Advisor because of stuffy academic objections that he was not actually a professional economist, which you might have thought was his principal qualification. And speaking of reversals of expectations, the media miracle in suddenly discerning an economic recovery right after the election continued its amazing course. There was lots more evidence this week that while the economy is still anemic, the country is definitely not quite in the terrible depression that we had been led to believe. Retail sales have now risen for the 5th straight month, with the October report now revised to show an increase more than twice as strong as had been originally reported. Worker earnings are up, initial unemployment claims are at their lowest level in 2.5 years. Consumer sentiment is finally beginning to reflect these objective improvements, and the experts at Fannie Mae predicted that housing sales in 1993 will reach the highest level in 14 years. The evidence of an unmistakably improving economy was clear everywhere but in Washington, the city where George Bush refused to recognize that the recession was arriving, and where Bill Clinton now appears to be in danger of refusing to recognize that it is departing. 16 years ago, Jimmy Carter's then chief economic advisor counseled him and the nation, if it ain't broke, don't fix it. Whoever thought that some people today would be asking, Bert Lance, where are you when we need you? We tonight will try to sift through the fairy tale land of radical politics, reassuring appointments, and surprising statistics to find out what really is going to happen to inflation and interest rates in the next 4 years of Clintonomics. But first, let's see who was sucking whose toes in Wall Street in the week just past. The Dow Jones Industrial Average continued to play catch-up with the broader market, grinding out a 3rd straight weekly advance despite late-week profit-taking. The Dow added another 15 points to close at 3304.08. All these broader indexes, except the Amex, continued to set all-time records on Monday and Tuesday before fading as the weekend approached. But the developments heartened one of our chief elves, Alan Shaw, who upgraded from bearish to neutral on the next 6 months after noting a variety of improvements in the market's technical condition, including the daily number of advancing stocks over decliners. The index's overall +2 reading is its highest in 6 months. With precious metals continuing to tarnish and the dollar beginning to brighten a bit, perhaps the week's most satisfying news was that the ripples of economic recovery are not being accompanied by a new surge of inflation. Consumer prices rose a bare 0.2 of a point last month. Producer prices actually fell by that amount. And the bond market, encouraged both by these figures and by the initial moderate Clinton appointments, applauded. As of now, at least on this side of the Atlantic, nobody is getting crowned. Frank Cappiello, you have expressed skepticism about the durability of Wall Street's honeymoon with Bill Clinton. Will this week's appointments help keep it going?
Yeah, I think it extends at least the believability that he's a moderate, but I still think the danger zone is going to occur sometime in February or early March when we get a look at his spending programs and Congress's wish list. But short term, the direction is a slight, I think what we're going through now is what I call a slight retrenchment. There's an old saying on Wall Street, Lou, that if the bulls have Thanksgiving, the bears will have Christmas. And we're getting a little bit of that, a pullback.
As I recall, it didn't happen last year, though.
No, it doesn't happen every year. No.
Oh, well, I was going to use that, too.
Well, Jesus. Lou, don't keep on using my material.
Now, this Lloyd Bentsen appointment and some of the others, are they going to influence Bill Clinton, or are they just going to implement the policies he announced during the campaign?
That's the big question. I mean, is he using these guys as screens, and then he's going to do what he wants to do? But I think Bentsen is a strong enough person that he has an agenda, and I think the savings agenda will be a plus for the economy. And I wouldn't. I would say the best of all the appointments was Panetta, because
Panetta, the head of the Office of Management and Budget,
right? Which is really if you're going to be a budget deficit killer. You need someone in there that knows the congressional system. and I think he's a real plus. But here again, while the course of the market is up, and I don't think people should get out of the market, and I think you should continue to buy stocks, you got to be careful because there's going to be a honeymoon end somewhere along the line in a couple of months.
You'll tell us when to sell, will you?
I'll be here, Lou.
Okay.
All right.
Lou Holland, what do you make of the week's developments?
Well, I would agree with Frank in that I think the market's going to continue to move higher. But I think it's important to note that we're longer than 2 years into this bull market. And the sentiment has started to get a little bit giddy. The IPO market has gotten to be red hot. The stocks are going up 10, 12, 15 points on the offering. Typically, this has been a harbinger of trouble. I think investors should really focus in on specific companies. There are some cheap companies still around. I like Sallie Mae, for example, is one of them, which has been beaten up because of Clinton's discussion about changing the loans for students. So I think that if you focus on stocks, I think you're going to do relatively well.
Do you think that Clinton won't make the changes there that people expect?
I don't think so. Here's a company, for example, that's selling about 13 times earnings. It's growing at 20% a year. Its return on equity is over 30%. You know, they've been around for a long time, a pristine company, strong Washington ties, so I think it's going to survive. Ralph
Acampora, you represent all the elves tonight, so tell us what you think about technical conditions in the market.
Lou, I keep hearing, and I think I hear it around the table, that people are looking for an up market. Because they're basically still cautious. I think you're going to have one of the strongest first quarters we've seen in many, many years.
In the market?
Yes. And I think it's going to be part of the honeymoon. I think it's going to be people feeling more euphoric about the economy, about the presidency, what we're doing in Somalia. We're going to have a wonderful feeling. I think the market has broadened out. We have very good leadership. You're starting to see the Dow catch up. My only problem with this is I think it will end on speculation. And the seeds that we plant in the first quarter will probably have to take many months to unwind. So towards the end of the year, you could be talking about a 10 to maybe even a 20% correction. But it's going to be a great first quarter.
An exciting beginning.
Yes.
I can't wait. Let's get this quarter over with. All right. Now, this is the point in the program when we normally pause for a round of viewer questions. Tonight, though, that time goes to your local public television station as it enters the stretch run of its pledge drive. When we go off the air, you'll have this last chance to show your support for this program and give to a worthy cause in the process. And next week, we'll be taking you off the giving list and putting you back on the getting list. So keep your own questions about love, money, and the meaning of life coming to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest and discuss the outlook for interest rates under Bill Clinton, let's take a look at the dramatic change that has occurred in the relationship between short-term and long-term rates during George Bush's presidency, as Chairman Alan Greenspan and his Federal Reserve teammates have been throwing us a curve. Here's the month-by-month history of short-term interest rates since the start of 1989, as measured by the percentage yield on 3-month Treasury bills, a rate over which the Fed has considerable control. The yield has ranged from an inflation-squeezing high over 9% in March 1989 to below 2.7% just 2 months ago, with today's yield of 3.32% still among the lowest of the past 30 years. Now look at what's been happening to long-term rates during the Bush presidency. These rates can be influenced but not controlled by the Fed and are actually set instead by market expectations about inflation and government debt generally. These rates have shown far less movement, with a decline of under 2% from peak to trough. The current long-term rate, as measured here by the yield on 30-year Treasury bonds, is 7.44%. At the start of the Bush administration, as you see, you could get a higher yield by lending to the government for a mere 90 days than by tying up your money for 30 years. That unusual situation, known as an inverted yield curve, is characteristic of a period of tight money that normally portends a severe slowing of economic growth. In vivid contrast, long-term rates today are more than 4 points higher than short-term rates. The more usual relationship between the two, but an especially steep one. Indeed, the gap between 30-year and 3-month yields this fall was the widest ever. This big gap reflects the Fed's repeated efforts to generate economic growth by lowering rates in the area it can control, the short term. As a measure of its success, here is the complete yield curve as of today, showing that at every stop along the way, the longer you're willing to lend Uncle Sam your money, the more he'll pay for it. Where are short and long-term interest rates heading next? And should investors now be heading for the exits? For some thoughts on that, let's go over now and meet tonight's special guest, Keith Schappert. Kim, welcome. We're pleased you could come down tonight.
Glad to be here, Will.
Please. Keith Schappert, whose friends call him Kim, has the distinction of being the active manager of more money than any other guest in the history of this program, trifling $55 billion, which happens to be the total of fixed income investments at J.P. Morgan Investment Management. He's been helping to build the pile there for 19 years, but this is the first time he's given anyone a television interview, and we are very pleased to welcome him. Kim, the conventional wisdom is that when the economy picks up, the bond market declines. Now we're seeing the reverse reaction. The bond market's thriving despite the economic pickup. What's going on?
Well, I think that reflects people's optimism about the outlook for inflation. I think, as you mentioned earlier, we've had 2 statistics released over the last 2 days, which gives bond investors comfort that inflation will stay relatively low. I think our view right now is somewhere around 3%. So if you look at the bond yield on a 30-year Treasury of around 7.40, 7.45, that's a very high real rate of return, and we think that can be maintained for a while.
What is the impact of Bill Clinton likely to be on these rates?
Well, I think when you talk about conventional wisdom, I think the greatest concern was that we had a Democrat coming into office on the mandate of stimulating the economy at a time when we had a very large budget deficit to begin with. And I think our response, very similar to others, was one of great caution. His decision to name a number of people that Wall Street is familiar with to very important economic posts has given us some comfort and encouraged us that maybe we'll see an administration that looks more Republican in how it acts than maybe the Republicans themselves.
John Kenneth Galbraith, nobody's idea of a Republican, once said, economists predict not because they know, but because they are asked. So tell us, a year from now, where's that 30-year rate going to be? Where's that 3-month rate going to be?
Well, I don't think the 30-year rate is going to be much different from where it is today. I believe that as the economy picks up, we will see some modest upward pressure on short-term interest rates. So from the 3.5 level today, they could be around 4.5 to 5%. At the same time, I can't see an economy that will grow strong enough to cause us any great concern regarding inflation. So I think the bond could be anywhere from 7.25 to 7.75 by the end of 1993.
Do you think that that rise in short-term rates will be enough to torpedo the stock market?
Actually, I don't. I think from our standpoint, that rate will really reflect as the economy begins to grow, just a decision on the part of the Fed to make sure that things don't get away, but we will sustain a level of growth that should give stock investors comfort.
Given your forecast of less than dramatic movement in the long-term bond, would you buy them?
I would. I think long-term bonds provide good value right now. What I would like to tell people is that I think they need to temper their expectation for bond returns. Bonds have been a home run for the last 10 years. We've had returns that have compounded at better than 12%. Mathematically, it's impossible to continue that unless interest rates go to 0, and I don't think anyone would forecast that at this point in time.
Kim, we have a lot of viewers, this may surprise you, who do not have $55 billion, but we have many who are concerned about income. If somebody came to you and with money for an income portfolio, how would you divide it now?
Well, I would put a very large share, and when I say a large share, maybe 75 to 80% in an intermediate to longer-term bond fund that's well diversified between treasuries, corporate bonds, and government mortgages. I think people should really focus on just getting the yield return rather than expect any principal appreciation.
And would you also invest, for example, in mortgage bonds separately? What would your view on them be?
I think so. Our view right now at J.P. Morgan is that mortgage securities offer very attractive yields relative to treasuries. If you look at a 10-year treasury somewhere around 6.75, a mortgage security of the same maturity will offer a return about 75 to 80 basis points, 0.75% higher yield, and you can get them government guaranteed.
Time for me now to yield to the panel, starting with Frank Cappiello.
Thank you, Lou. Kim, most of individual investors do not buy bonds singly. They usually, if they're going to go into bonds, buy a bond mutual fund. What would you tell our viewing audience regarding bond mutual funds? What should they look for in terms of a fund? What characteristics?
Well, I think the critical thing at this juncture is really the maturity of the bond fund they're investing in.
The length of the bond.
Yes,
bonds.
because while I'm talking about being optimistic, we still are at the point in the economic cycle, traditionally, we start to see some upward pressure and concerns. So that I think you want to protect principal, and you do that by being in the intermediate sector.
Kim, there's a lot of interest in international bonds because they're yielding more in many areas of the world than U.S. bonds. How are you dealing with the problem of currency risk in your funds that you manage?
Well, when you talk about international bonds, that's really an area that we think right now provides the greatest opportunity to realize double-digit returns. Right now, in looking at Europe, Germany in particular, but some of the surrounding countries, whether it's Belgium, Holland, or France, offer what we think are potential double-digit returns. But the key, as you suggest, is hedging out the currency, because our view over the next 6 to 12 months is that the U.S. dollar will appreciate versus those currencies. And I think the best way to play that market would be through a mutual fund that either is fully hedged or where they give the advisor of that fund the opportunity to manage the currency exposure.
Kim, so many of us have gotten so comfortable with those high yields, the CDs. What kind of bonds could we implement now to kind of capture some of that yield, but maybe not all of it, obviously?
Right. Well, I think people who are in short-term money market funds, who at one time not too long ago were yielding 8 and 9%, who now find they're getting 2.5%, 3%, should have moved out the yield curve more in the intermediate bonds at an earlier date. But I would still recommend that it's a very safe investment right now to buy a portfolio of intermediate securities with a maturity somewhere between 5 and 6 years. And you can pick up somewhere between 3 and 4% additional yield by just going to the intermediate sector of the marketplace. I wouldn't advise trying to go out and get an extra percentage point given the risk you have of being in the long end of the marketplace.
You're taking a cautious view, as is appropriate for a fellow who's won all that money. Would you advise against buying the long-term Treasury bond at this point?
For other than professionals who trade the marketplace, I would suggest it's much better to be in the intermediate sector of the marketplace. You don't give up a lot of yield. You get protection. The way you can get the same yield as you would on a 30-year bond is by being corporate bonds and mortgages of that intermediate maturity. So I think you can get the same yield, which is what investors really should be trying to achieve right now, rather than principal gain.
As I understand your forecast, you think we're going to have a narrowing of that yield curve. We're going to have short-term rates rising pretty rapidly, or at least up a point or so, and we're going to see long-term rates holding pretty steady. How can speculators play that change?
Well, one of the ways is just as you described, a change in the shape of the yield curve, what we would describe as a flattening of the yield curve. And that can take place by either short rates moving up or long rates coming down, or maybe a little of both. And there are trades that you can put on which will benefit from that flattening of the yield curve in the futures market. Again, I think there are a number of funds where people use derivative instruments where you can take advantage and realize returns above what you could get just typically on a bond portfolio.
What's the biggest surprise that could change your forecast on rates?
Well, one of the surprises would be if Mr. Clinton really turns out to be a Democrat, which he may very well turn out to be.
Well, those words don't mean much when it comes to actual policy, does it? But you think that he's starting out with a focus on the deficit, which is certainly what the bond market is concerned with, isn't it?
Yeah.
And if he follows through and reduces the deficit, the bond market will anoint him as a hero.
We'd love him. But at the same time, we recognize the fact that he was elected on the mandate of getting the economy started. And while there's been evidence the economy is growing, will he be able to resist some of the pressures from fellow Democrats who supported his election not to stimulate the economy or not to respond to some of their spending programs?
Thanks very much, Keith Schappert, for at least a half cheer from an unexpected quarter for Bill Clinton. Thanks to the panel. And hope you'll all be back with us again next week. Then we'll talk with a man who has a mania for speed. He's Jim Junt. He's compiled one of the best investment records of the 90s by finding and jumping on only what he identifies as the fastest growing companies. So quick, let's find out what he's clocking now for the next lap around the trap. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been made possible by the Corporation for Public Broadcasting and by the financial support of viewers like you. By the Travelers, providing American business with insurance, investment services, and managed health care. The Travelers. by MFS. MFS, helping mutual fund and institutional investors achieve their financial goals since 1924. And by Prudential Securities, rock solid market-wise. Prudential Securities, celebrating 10 years on television with Wall Street Week with Louis Rukeyser. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.
This is PBS.